Obviously, yet another crazy day in the market. We have had the biggest 2-day drop now since the pandemic in 2020 in the S&P, and I think it's down even more than when Bloomberg posted this chart earlier today. And this isn't, it's important to realize, that look, I mean, we've been warning for in the past, year or more about the valuation risks in the market, especially with the Magnificent Seven and large cap equities and the over concentration in equities among U.S. investors at some of the highest levels historically ever, equities relative to their overall financial holdings, and record over owned equities, record valuations. I mean, these are setups for some problems, and the catalyst certainly has been the trade war, the Trump tariffs, but this was a bubble that was ripe to burst, and now it's in the process of bursting. And so two of the biggest down days now since 2020. Let's go on to the next here. But this is the Mag 7, and I apologize that this is so small. But look, the Mag 7 is down already. More than 26% now since its high. So we've had a 26% correction in the Magnificent Seven stocks. And look, this is what we have been positioned for, what we've been warning about, what we've been positioned for, and through put options in these Mag 7 stocks and the S&P 500 and the Nasdaq 100, and in the different Mag 7 stocks. So we've been able to capitalize on this in our global macro and long short hedge funds already what's happened year to date. And but one must be careful, because now is not the time to be aggressively adding to short positions or to put options exposure. Why? Let's look at the next chart. The volatility index, or the VIX, which today spiked up to 40. These are historic levels. This is going back to 1990. You can see when the volatility index spikes, this is the amount of premium that one has to pay on put options, for example, to get exposure to short positions. This is not the time to be adding put option exposure. This is the time to be taking that exposure off, and that's what we've been doing here at Crescat over the past yesterday and today. In our equity short exposure, and just be careful, because a lot of commentators are coming on CNBC and Bloomberg and saying it's time to short stocks, and maybe time to take a little pause here and take a little breather, because we have had already one of the biggest VIX spikes in the history of the VIX, and one of the biggest 2-day corrections already. Now, these are things that we've been preparing for, so be careful out there. Let's go on to the next. Jay Powell, our Fed chairman, was on today. A lot of people were hoping, and Trump was even trying to get him to announce a rate cut, and he basically said, no, we're sitting on our hands here. And why? It's because there's still decent employment. There's still we had a payroll day today, decent jobs number, and unemployment's still low. And yes, there's risk of contagion from the market correction and the tariffs and the potential for recession, and but there's also the potential for high inflation too, including with tariffs. And this was the University of Michigan, which came out a week or two ago. 5 to 10 year inflation expectations. This is the median. The mean inflation expectation is even higher at truly historic highs. But the median inflation expectation, is still a problem. So we have all this, but payroll still looks good, but there's a potential for economic slowdown, especially with the massive tariffs and and high inflation expectations at the same time. And it kind of feels like stagflation. It kind of feels like the Fed is trapped, but the Fed is sitting on its hands. And so we these are the conditions why the stock market is having problems here. And inflation expectations are still a problem, and it's something that we're going to have to contend with. Let's come down to the next. So one of the trades that we've had on recently in our global macro fund has been a high yield credit spread, widening trade. We believe that that junk bond credit spreads have been just too tight for too long. Well, we're finally getting that blowout in high yield credit spreads. How we have expressed that trade is by being long the both the 2-year, both the front end and the long end of the curve. Honestly, both 2-year notes and the long end of the curve as well in 30s. It's kind of a barbell strategy, and we've been short the HYG. We've been, again, we've expressed this through puts, but to play the credit spread widening. This is a trade. I think that there's a lot more still to play out. Unlike the VIX on the equities that's already spiked enormously, this is really only the beginning of the blowout in high yield credit spreads. So while we have taken some profits on that trade, we still remain exposed to it. So let's look at the other side of that trade, which is both the 2-year note side and the long end of the curve. Here we're looking at 10 years. The entire Treasury yield curve has been coming down. This is it's a little bit contrary to what some people might think with rising inflation expectations. How on earth can yields be falling along the Treasury curve, especially with the huge federal deficits and the inflation concerns? And well, this has been the objective of the current administration. They want to get yields down across the curve. They want to get inflation expectations down as well. And one way they're doing it is there's no Trump put on the stock market. This is part of the negotiations. I know a lot of people think that doesn't make sense what Trump is doing. I believe there is a grand plan, a grand strategy behind it. It's a geopolitical strategy. It's a military strategy. It's a trade strategy. It's a rebalancing of the economy strategy. It's kind of what he ran on and what he got elected on. But look, this stock market was ripe for a correction. Regardless, trying to save the stock market is not his objective. So there's no Trump put on the stock market, and there is no Fed put either, because Jay Powell is sitting on his hands. So this is what we get for now: free falling stock market, but yields coming down, junk bond spreads blowing out. There's a lot more to unfold, but if you've been short, if you've had equity put option exposure, now's the time to be taking it off, not to be adding more. Now's the time to be cashing in my opinion, and that's what we've been doing in our long, short, and global macro funds. And what's that resulted in? Let's go on to the next. This is just through February, where we already started to capitalize on these put option exposures in our long, short, and global macro hedge fund. Crescat's funds through February, among the whole Preqin database, 1,872 hedge funds with at least global hedge funds with at least a 3-year track record. global hedge funds, meaning all hedge funds, in the Preqin database, we had 3 of the top 10 performing funds. This is just through February, and that's our global macro fund, our long short fund, and our precious metals fund. This is our X side pocket performance. So it's the performance that new investors coming into the fund, into our funds, would receive and have been receiving. You can go to our website, read our full fund side pocket and X side pocket performance. We do have one investment, San Cristobal Mining, which is one of the largest silver mines in the world. Our funds are the largest shareholder. That investment has been placed into a side pocket, and you can look at the returns on that separately on our website if you're interested. But that's not available to new investors coming into our funds. They get the X side pocket performance, which is what we're showing here. But this is through February. Most funds haven't reported their March yet, year to date. So let's look at March. So in March we had another really good month across the board. This is when our short exposure really started to kick in global macro and long short. We've been short the Magnificent Seven. We've been short the S&P. We've been short the NASDAQ 100 through put options, primarily on these instruments, and we have been, as Jim Cramer would say, we've been ringing the register. We've been cashing in on a lot of this, so we're in a good position now with liquidity and cash, and now with the precious metal stuff pulling back, we're able to deploy more capital towards those trades. It's not that we're giving up on the short side of the market here. There's going to be an opportunity. We don't think this overall correction is over, but look, there's what kind of news are we going to get now with with potential trade partners, coming to the table, doing deals. There's the potential for a significant bounce in the market. Things could just keep going down. I'm not saying that that's not going to happen either for equities at large. And we think there is more downside in general. I mean, this is only the beginning of a significant correction, because we're coming off of record valuations. But look, through March, our global macro fund up 59%, with S&P down 4%. The S&P is down another 10% month to date, and we're doing okay month to date. Global macro fund is up, and the market's down 10%. And a lot of that's due to our high yield spread trade, which is in the global macro fund. The long short fund is also hanging in there pretty good. But we have cashed in on our short exposure, because this is not the time to be adding substantial short equities exposure, especially through put options right now. It's time to be taking a little bit of a pause. What is it time to be doing? It's time to be looking at putting money into the precious metals side of things, because we're finally getting a pullback in gold. We're getting a significant pullback in silver. Tavi's going to be talking about these things, and so now is really the time to be thinking about that, because rates are coming down. We're going into a world of interest rate repression. There's still going to be inflation. I think there's a real opportunity, especially on the mining front, where the valuations of mining equities are still extraordinarily low relative to this improved metals price environment, the improved free cash flow that some of the senior producers are delivering in this market. And in the junior space, where we have a significant focus on the exploration sector with both companies with bona fide discoveries and incipient discoveries across gold, silver, copper, zinc. We have some of the biggest, best new metal discoveries around the world, and these companies, we believe, are substantially undervalued, and there's an opportunity to put money to work in the early stages of a major new precious metals bull market. We don't think we've seen anything yet.